Okay, welcome everybody to the second day of our 30-year commemoration of the ERM crisis. Yesterday we discussed the rise and the fall of the ERM, and today we will be talking about its aftermath. We're going to start with a discussion of what really was a decade and a half of optimism and the birth of the euro. And you can see my virtual background is Maastricht. And in fact, that was my background to my graduate studies at Berkeley. We had a reading and discussion group on promises and risks of the single currency for euro. And many of those promises and risks actually came to be. And we're going to discuss that today. For this session on Decade of Optimism, we have four distinguished speakers. Actually, only three of them are now present. We'll see if William will join us later. They will start with 10-minute introduction remarks, and then we will open for discussion. If you're on a panel, you can raise your hand or put a comment in the chat. If you're a participant, you can put your question in Q&A, and I'll do my best to call on you or read your question out. And so we will start with Lucrezia's remarks, then go to Charles, and then Andy Rose. Take it away. You have 10 minutes.
Okay, thank you. So we are in the boring panel, you know, the 10 years of illusions and optimism. And actually, I want to start with something that Giancarlo said yesterday. It is a paradox that the EMU, at least partly, because, you know, partly was motivated by political consideration, but at least partly was motivated as a response to the exchange rate volatility of the previous, the crisis of the previous decades. But then it was designed as a system which had all kinds of rules, but no crisis management tools. And to understand the origin of this problem, I thought that maybe it's interesting to go back to the discussion that preceded Maastricht. And I think two things were important. So first of all, at the conceptual level, but also reflecting a difference in political preferences, was this debate between the so-called economists who thought that economic convergence of economic structures was required before introducing the single currency. So that we needed deep political integration also in order to, to govern and legitimize, such goal as the monetary union. And then the so-called monetarists, mostly the French, which thought that actually establishing the monetary union was like a step that would have facilitated further integration. The second important thing was that sometimes in the 80s, there have been a conceptual revolution starting in the US on the practice and theory of monetary policies, leading to a consensus on the role of the central banks and the architectural and the institutional design of central banking, which led to inflation targeting or something similar in a lot of different countries. Now, especially this second thing, okay, so this new consensus on the importance of price stability as the anchor facilitated the work of the Delors report. Because it could take as a grant, as an established consensus, the role of the future central bank. Now, the role that facilitated the role of the possibility of finding a consensus in the drafting of the report. However, it did not, of course, the differences between the so-called monetarists and the so-called economists, continued. Influence the discussion about, how to get to the monetary union. Now, the Delors report offered a compromise. It introduced the single currency as one of the possible solutions, okay, as an option, not a necessary element of a monetary union. as a key solution of eliminating exchange rate volatility. As in the Werner report, which had been written in the early 70s, propose a gradual path towards monetary union, consisting of the three stages, okay? First, policy coordination, second, establishment of the monetary policy fund, and then eventually the creation of the common monetary policy. And the report recommended the imposition of binding limits on national budget deficit in the final stage, but also, and this is key, envisage procedures to coordinate macroeconomic policy and to ensure an appropriate union-wide stance of fiscal policy over the medium term. Now, this compromise that was offered by Delors was actually, not very successful at the beginning, and actually the Delors report was kind of, became important again after the exchange rate crisis, and it became kind of the blueprint for what then became the Maastricht Treaty and, and the architecture of the monetary union. But it's key that when actually the treaty was designed and signed, it followed the blueprint of the Delors report, but not completely, okay? So, for example, rules constraining national fiscal policy were included, but proposal for coordination of macroeconomic policy to ensure an appropriate area-wide fiscal stance were dropped. And basically, the Maastricht Treaty became an architecture based on rules rather than discretion. So on that, what had become known as the German point of view in the discussion of coming to the signing of the treaty. So, moreover, important missing elements of this architecture was, as I said at the beginning, the lack of crisis management tools. So it was very much a system focusing on prevention rather than crisis management. No clear responsibility of the European Central Bank as lender of last resort. However, the operational model of the ECB as it was designed turned out to be very appropriate in dealing with that particular function of lender of last resort, which is, to become an intermediate, intermediary, when the liquidity crisis struck in 2007. So, it was a kind of mixed blessing, the way in which the central bank was designed. And of course, as we all know, I mean, there was no clear debt restructuring mechanism and the lack of focus on the importance of the financial market. Now, in the first 10 years, this construct was seemed to work, at least superficially. There were some good things that I remember in my years at the ECB were always emphasized: nominal convergence, which had led to price stability, low interest rates everywhere, though small differences in inflation persisted. But the risk premium went to zero, and basically interest rates became unresponsible to fiscal shocks, during those first 10 years. And this was a period in which retail financial integration did not progress, but capital flows were actually very important in explaining what happened in the periphery, and in particular in Spain and in Ireland. Actually, what happened, given the persistent small difference in inflation, was a big, negative shock on real interest rates, especially in Ireland and in Spain, which led to a booming consumption and the housing boom that then, kind of created those fragilities that then were important to understand why these countries were not, were not able to face the great financial crisis when it came. So I think it's central, exposed with the benefits of insight, to understand that this lack of understanding the role of the financial sectors at capital flows was a problem in the design. The capital flows from the global banks in the north and the local banks in the south were one of the reasons why financial fragilities were accumulated, high leverage, unstable funding, big reliance on interbank and non-domestic financing, and increasing counterparty risk due, to risky investments, including sovereign. So the banks from the north intermediated large capital flows from the core to the periphery, encouraged by growth expectation, motivated by ample liquidity. This distorted the risk assessment, and that was also made possible by poor regulation. Those were the years in which, regulations were still, the preventing arm of, so the banking union was not in place. The other effect of this was external imbalances. Again, this for few of the countries of the periphery. Less clear was the role of the real exchange rate appreciation in some of these countries. This is something that I'm sure that Charles will talk about because, I think when you look at the narratives, it's very difficult to fit a narrative that fits all countries. Especially, for example, the lack of competitiveness. We have, in Italy, nothing much happened. We continued the decline that had started already in the early 90s. So it's difficult to associate that lack of competitiveness to the real exchange rate. So nothing really changed. In Ireland, actually, it is true that there was a real exchange appreciation, but there were also rapid advances in productivity and competitiveness, where the real exchange rate was a problem, was possibly Portugal and possibly Spain. So, basically, there is not a history that, there is not a narrative that fits it all, but clearly financial fragility in some of these countries were a main issue of vulnerability. Now, let me say with just conclude with just few facts. When you do like a broad macro quantitative analysis of what happened to the real economic conditions in these countries of the euro area pre-crisis, the conclusions of these studies is that actually real asymmetries did not increase during those first 10 years. That's a story of the crisis. It's not the stories of the first 10 years. Also, business cycle correlation did not change with respect to the historical experience. So basically, this asymmetry is really a story of the next decade, and it has to do with the way in which the economy, these economies reacted to a large common shocks, and the lack of crisis management tools. I finished that here.
Thank you, Lucrezia. I want to pick up on your point of non-responsive interest rates. I don't know if people remember, but Willem Bouter wrote a paper in 2005 about the ECB collateral policies that kind of set the stage for this kind of sovereign debt mispricing, if you will. And I don't know what he would say if he were here today, but that's what he said 3 years before.
I can tell you one thing, that when I was at the ECB, we were always, there was this kind of lunch of the director generals, and we were always, commenting on the fact that those interest rates were not moving. No matter what happened, that Italy would do something crazy or Greece and so on. Before 2008, the spreads were zero.
Zero. All right, Charles.
Well, thank you very much, and glad to be back here today. Let me share my screen, because I've worked hard on my presentation. Here we go. All right, so the title of this session is about optimism, the period of optimism, and I'm going to say yes, but also a period when we forgot to do what we had to do. after the big crisis in '93, there was a nice, easy period. The ERM was not an issue anymore because we had these huge bands of fluctuation plus or minus 15%. So it was more akin to a floating exchange rate, but not quite. This is the time when we were thinking about target zones a la Krugman. So there were limits, but no currency or no pair of currency, I think, ever got close to testing the limit. And in fact, exchange rates were very stable. And I think what was important was the anchoring. So now when we talk about anchoring, we talk about inflation expectation, but I think exchange rate expectations were very important. There was the idea that within a few years, we'll all converge to the same currency, and that was certainly anchoring exchange rate. Of course, if there had been shocks, that would not have happened, but it was a nice, quiet period. There were a lot of discussion at that time in economic and policy circle about admission criteria. So some countries were making noises that we need only a small group of countries completely dedicated to what was called stability, and others. It's Lucrezia who talked about the economies versus the monetary. So that was part of this discussion. Now, at the end of the day, everybody who wanted to join was admitted. There was just a sacrificial lamb, Greece, that was said, well, you're not quite there, another 2 years, and they joined. So that was a big debate at the same time. And there are questions now about whether it has cost growth, because everybody wanted to be as good as Germany in terms of inflation. So it may have been costly. At the future central bank, there was a lot of background work to design the central bank as an institution and as a strategy. And it was clear the Bundesbank was in the driving seat. They knew what they wanted. They wanted a Bundesbank, a type of institution, and nobody was either willing or able to challenge them. As we discussed yesterday, they were considered as the right way of doing monetary policy. And then in the middle, there was the stealth adoption of the Stability and Growth Pact. I put here Jacques Chirac and Schröder, who were presiding over France and Germany at that time. Chirac had no clue what the Stability Pact would be, had no clue what monetary policy was. And Schröder, I don't know, his new fame about in Russia mean that maybe he knew what he was talking about. But anyway, that went through. The German asked, everybody else acquiesced, and that was it. Now, 30 years later, the Stability Pact is still kicking and is still missing all its objectives, or most of its objectives. The pact reflected a fascination with completely arbitrary numerical targets. So there were lots of discussions to try to make sense of 3% and 60%. Never made sense and doesn't make sense now. And there was this mistaken focus on sanctions, the idea that we're going to punish countries that misbehave. And of course, we never punished any country, although there was a lot of misbehavior. So that was the 90s before the creation of the euro. Now, what did worry about? And Lucrezia talked about the euro period. I will briefly go over it. Now, I did go back to the literature to find out what we were talking about at that time. So I didn't want to be confused by my own hindsight. So I reread all the MECB, monitoring the ECB series that were published by CEPR. Here I want to draw my hat to David Begg, who was the force behind that. And I tried to find out what we at the CEPR and the people at the CEPR were worrying about that time. So there was a lot of concern about the two-pillar strategy, which was very confused, and report of MECB report after MECB report kept repeating the same thing, saying the strategy has to be clarified, and there was a concern that it would lead to a contractionary bias because of the under the influence of the ECB. Now, other things that were discussed at that time, there was at least once, but more than once, references to the fact that there was no, what we call now a banking union, that banks were being supervised, regulated at the national level, and there was this perception that it was a recipe for disaster if there were to be a banking crisis. There was a lot of discussion too, well, reasonably lot of discussion about the weak institutional of the arrangement of the ECB, where there was a center, but there were all these national central bankers floating around to create a monetary policy committee, which was too large to be healthy. And there were a number of discussions about how we could do essentially going the Fed way by reducing the number of people who can vote. There were, as you can see, transparency was a big issue. People were, colleagues were complaining that it was hard to make sense of what the ECB was trying to do because it was talking in a strange way with the one pillar here and the other pillar there, and not just that. So it was perceived as opaque. And of course, there were lots of discussion about the Stability Pact, not in the MECB series, because that was about the ECB, but this is something that didn't stop during this whole period, discussing the effectiveness or ineffectiveness of the pact, and observing that policies were pro-cyclical. I'm told to hurry up. I will. Now, it was so things went well, but there were a number of issues that were not solved. And that's what I think it was a lost decade. By and large, monetary policy was successful, and Lucrezia explained that by noting that there were a few shocks, one large one, 2001 with the dot-com crisis, but they were symmetric. The responses showed that there was no contractionary bias at the ECB. It was just acting occasionally a bit slowly. On the rest of the issue, transparency, two-pillar, there was limited progress. The two pillars, what we found out is that there was talking and there was doing, and at the end of the day, despite all these references to the two pillar, the policy was pragmatic over the doctrine. There was a total lack of change on the Stability Pact. There was a big reform in 2005 after first crisis, and this was a terrible reform because it opened the door to complexity, to arbitrariness, and that's a trend that has continued after. Any time the Stability Pact is failing, now we put another layer of complexity, so we don't understand, nobody understands what's going on. And nothing happened about banking. It was a totally missed chance. So Galina, I'm coming at the end, don't worry. The conclusion is that the issues that were discussed and raised in academic circles were not properly taken care of, and the ECB was completely ready to fail in the front of asymmetric shocks. And of course, when you're ready to fail, it happens. And we had the global financial crisis where European banks went on the loose. There was no proper way of dealing with them, where public debts got unhinged. and that led directly to the other big crisis, which is it was the euro area debt crisis. So in that sense, lots of opportunities have been missed to do the right thing at the right time. And here I stop. Thank you very much.
Charles, Andy?
Yes. I'm trying to. Yeah.
Okay. Thank you. Okay. So I want to talk about the that period of time, but from a different perspective. So here's my take. The ERM crisis was absolutely critical in starting everything off. And of course, it affected the UK and Sweden, France, and the periphery. But the most striking thing then was not that it stayed in Europe, it went on, okay? So there was a big exchange rate crisis in 92, another one in 93, obviously both in Europe. 94, Mexico hit, and there was the tequila crisis that hit Mexico and Argentina. A couple of years later, there was the Asian crisis that started off in Thailand, hit Korea, Indonesia, Hong Kong, the Philippines, then moved on to Brazil and Russia. The mid to late 90s were filled with currency crises, okay? And those no longer exist. Why don't they exist? Okay, well, I guess my view is a fix is a well-defined monetary policy, a float is not. And before the early 90s, essentially before the ERM crisis, there was no easy, viable alternative to fixing your exchange rate in terms of well-defined monetary policies. That starts to change. Now, I do say this with a sob in my heart as a member of the British Commonwealth, but even though inflation targeting had started in New Zealand, Australia, and Canada, it was pretty obscure until the exchange rate mechanism crisis, because then, right after that, all of a sudden you had countries like the UK and Sweden, big European countries that gave intellectual credibility to inflation targeting. And the emergence of inflation targeting as a viable alternative to fixing the exchange rate is a huge positive legacy of the exchange rate crises of the early 90s. All of a sudden you had Sweden, Finland, Norway, the UK, Spain, Poland, Slovakia, Turkey, Romania, and those are just European countries engaging in inflation targeting with tremendous success, okay? So that, so far as I can see, is a critical thing in understanding why there was so little work done on international monetary policy, because everyone was focusing on the emergence of inflation targeting, which was, I continue to think, probably the most successful monetary framework in the history of the world. So just briefly, what is it inflation targeting consist in? The standard thing is it needs approximately 5 ingredients. First, you have to have a numerical, publicly stated medium-term inflation target. Secondly, you need price stability as the primary goal of monetary policy. Third, use all the information, an information-inclusive strategy to set your instruments. Fourth, high transparency. And fifth, high accountability of central bank for inflation targeting. And it really just took off after the wave of exchange rate crises in Europe, but then in Latin America, in Asia, and the entire world. The exchange rate crises that we experienced starting in Europe in the early to mid 1990s led to the widespread adoption of inflation targeting. Now, inflation targeting is very different from the fixes that preceded it because inflation targeting is an extremely durable monetary regime. Essentially, no countries have really ever left it, with the exception of Argentina. Only Argentina has dropped out of an inflation targeting regime, which cannot be said of the many countries that had fixed exchange rates. Fixed exchange rates are typically extremely short-lived, and after you drop out of a fix, you have to do something else. So it was this convergence into inflation targeting that was the key legacy, and so far as I can see, a very positive one associated with the exchange rate crises that started in the 90s. So I only have a couple minutes, but let me draw some contrast between the current regime, which is inflation targeting for many, many currencies in the world, with the preceding period, and the only really well-defined preceding period of monetary stability was Bretton Woods. So if you compare what we're in now, inflation targeting, to the previous period of stability, Bretton Woods, regimes are much more durable, because remember, inflation targeting regimes last essentially forever with almost no exceptions. Of course, the exchange rate floats, and sometimes in a really volatile fashion. Ask any British resident over the last couple of days. But one of the reasons why inflation targeting is so durable is the focus of monetary policy, instead of being international, is completely domestic. And you simply rely on an intermediate target that you can easily communicate to the populace in the form of the inflation target, the inflation forecast. The key thing that we missed, I think, in the run-up to the global financial crisis was the key role of the US dollars and US treasuries. During the late 90s and early 2000s, there was no special accord paid to the United States. Whereas now I think we think that because of the special role of the US dollar to provide safe assets and a safe haven, and the enormous buildup in international reserves to provide stability to external shocks, especially in East Asia, the US has a special role, and that really wasn't captured at all. But the last thing I want to emphasize is during the period after the exchange rate crises and before the global financial crisis, there was a greater alignment between academics and intellectuals and policymakers on international monetary policy than I think had ever been experienced. Most academics really liked the alignment with inflation targeting that policymakers saw, appreciated the transparency, as Lucrezia says, appreciated the independence and growing role for central banks. And that is a tremendous positive legacy that I think we still appreciate today as a result of the exchange rate crises. Okay, I think I'll stop there then.
Thank you, Andy. So as a reminder, if you're a participant, you can put your question in the Q&A. Richard has a comment in the chat. I don't know if you want to, Richard, you can just talk about it since you're on a panel.
No, if you like. I simply raised, actually I was about to add a third one, reacting to Charles, that first he suggested that the EMI, the precursor of the ECB, was simply run by the Bundesbank. It was run by Alexander Lamfalussy, and Tommaso Padoa-Schioppa played a significant role too. Were they just creatures of the Bundesbank? I don't think, that's, we'd have to look more closely at the precise design and their roles, and I expect that historical documents will emerge that will help us in that. The second point I would make is that the very first monitoring the European Central Bank was subtitled "Safe at Any Speed?" query, right? And the authors raised the question of whether the absence of a lender of last resort and the lack of concern for financial stability in this new regime was a major weakness. And when I remember this very clearly, because when Tommaso Padoa-Schioppa got a pre-publication draft of this, and he was absolutely furious, and he rang me and said, "Richard, CEPR cannot publish this." I said, "What?" He said, it would be destabilizing. I said, "I'm sorry, the CEPR is giving a voice to the academics, and the academics have come to this judgment, and in fact, I happen to think they're right, but that's neither here nor there. I would never stop them. I would never say CEPR shouldn't publish because of that." So I think that was a major issue, and it turned out to be a major issue, actually, in the following decade. I'll stop. Oh, no, yeah, I said I had 3 points. The third point that got left out, which I think was important and was made, the analysis was done in another CEPR report of the how you were going to get to the convergent exchange rates at the introduction by the 1st of January, 1999. And the authors, I think, argued very convincingly that the markets would lead the way, that once the final exchange rate parities were announced, and when was that? I think it was June of '98, something like that. Once the final parities were announced, there would be market convergence onto those parities, because, provided that they were reasonably credible. And that's exactly what happened. There were lots of people out there saying, oh no, this is not going to work. I'll stop.
All right, thanks, Richard. So I have Lucrezia and Beatrice, but I want to throw a question in Lucrezia's direction, maybe Charles as well. So you both talked about the concerns about asymmetric shocks in the early discussions of the single currency. And my kind of interpretation of what happened then in 2007, 2008 is there was a common shock, but it had an asymmetric response. Was that kind of possibility also discussed, or people were just not imagining those building up of imbalances within Europe that could create that asymmetric response even to a common shock? So I have Lucrezia, then Beatrice, then Giancarlo, then Patrick.
Yes, I mean, I want to start with your question because I actually said, I was a little bit chaotic maybe in my presentation, but I think that actually the large symmetric shock was the big problem when the crisis struck, rather than asymmetric shocks. I mean, I don't know, there is always a kind of definitional problem there, but I mean, what was actually lacking was, the common fiscal capacity, all the crisis management tools that we did not have that made the crisis worse. But if you look at the data, actually, before this big large shocks came, which was the great financial crisis, in terms of the real economic activity, not much was different with respect to the previous decades. So there were all this imbalance being built in the financial sector. And here, I agree with Richard that the financial sector was key in understanding, the building up of fragilities and some of, the boom and bust of the smaller countries. But overall, I mean, the question is actually, how come that the monetary union did not help in that real economic convergence process that was a promise of that project. So, I mean, we have, nothing happened in the real economy, but, what we build up financial fragilities, and then when the crisis, the big shock comes, then of course some countries, go under. Now, on the land of last resorts, so to answer to Richard, I think there is a very important speech by Tommaso Padoa-Schioppa responding to the academics, saying, asking the question, are we going to be ready to a big liquidity, shock in the euro area, and a sort of a modern crisis, okay, which is basically a crisis on the interbank market. And Tommaso explained that, yes, the ECB was ready for that. And in fact, it turned out to be ready for that in 2007, 2008. The response of the ECB was great, okay, because it had that operational framework better than the Fed that could face that kind of crisis. Where it failed was later on with Greece and all that kind of stuff, because of this separation between monetary and fiscal policy, no restructuring mechanism and so on. But that's a different story. So I think we have to give credit to the design of the ECB in terms of its balance sheet and its operational framework, that it was extremely robust, and that helped in the crisis.
for his bank wasn't so robust. There were other banks that were not so robust, and there was a lot of cross-border financial intermediation that was not robust, and that was what should have been followed. More
Yeah,
closely.
but that's a different problem. Yeah, I agree. That was financial regulation.
Yeah, Beatrice, Giancarlo, Patrick, and Shaul.
So my comment is also prompted by what Charles said provocatively. As always, the first decade was a lost decade because it didn't prepare for what came afterwards. My recollection of living in Frankfurt during that decade is that the discussions were very intense, but they focused on something that turned out to be quite irrelevant, namely, in fact, how much inflation targeting versus old-style Bundesbank. The fact that there was this monetary left over in a way from the money supply target, which was never really taken very seriously, except in huge discussions. So my recollection is that in a way that decade, the discussion was not really the one that turned out to be the relevant one. And I mean, Lucrezia just said, okay, there were also some of the questions that were being asked were the ones that were relevant. So Charles, maybe asking the question to you, since you have reread all the reports from the era, how would you rate how much how much was the debate then actually on target? Relating to the outcome, not only real, that Lucrezia mentioned, the overall, for the first decade, the inflation rate in the euro area turned out to be 2.2%. So one of those big discussions that, the target was asymmetric and too low, de facto, the ECB delivered 2.2% on average for that decade. So we are pretty much a symmetric inflation target. The last one I wanted to mention, I have forgotten now. I'll come back later.
Hi, Giancarlo.
Yeah, very, very synthetically. Just come back to Patrick Dohanan yesterday mentioning the dollar D-mark polarization. This is one element of the global context that we have there about the fact that the euro was born in a period of much of dollar strength, the same way in which the 92-92 crisis happened in a dollar crisis, according to the economists. The launch of the euro was in a period of dollar strength. I wonder whether today the dollar strength is really a problem, or maybe has some memory of the old role. And I'm saying this because there is another aspect of those years. The underestimation of risk was not a European problem, right? It was a global problem. So actually, one of the questions for historians is whether Europe reunification contributed to the underestimation of risk, or we were just, a sideshow there. And that comes to my third and last question, which is, remember, we were quite debating the role of enormous cross-border banking flows, whether those would create more risk-sharing or less risk-sharing. And in my view, less risk-sharing was actually feeding inflation differential and lack of adjustment in the following years in terms of having payment that are contingent on the state of the economy. But I think it was quite a bit of a. I remember, I think people said that Trichet was going around all the meeting of the council, showing these graphs with the gross flows, asking even intellectual guidance how to treat those. There is a micro aspect that Richard and Lucrezia mentioned. There is also the macro aspect of it. We really did not know well how to deal with those phenomena at the time.
Patrick?
Yeah, 2 points. The first one about to what extent in this first decade did the single currency create those big capital flows? and were they the cause? And I think Lucrezia was more or less implying that the flows into Spain and Ireland and so on are really driven by the negative interest rates related to the fact that there was a single currency. But I'm not sure that was really an important driver. And the counter example is that you've got other examples like Iceland and Latvia, and generally the huge international banking flows that were happening, sloshing all over the world. And I'm not sure that anybody has shown that the flows were distinctively to the euro area, or that they were determined by the single currency. And my feeling is probably it wasn't. I know both in Iceland and Ireland, the flows certainly went through the city of London. They weren't really coming, hopping from Frankfurt or from, Amsterdam. Anyway, so that's the first point. The second point, not so sure about this, but worth thinking about in terms of whether it's a lost decade and people looking at the wrong thing. The ECB spent a lot of time, rightly, in those years from the macroeconomic analysis, focusing on modeling and understanding a new construct, which was the euro area economy. And the question is whether that came at the cost of understanding what were still important national differences, so that they were not, their early warning wasn't as well developed on the macroeconomic side for the individual countries. They were more, to some extent, leaving that to other entities. It's certainly they looked at individual countries, and you can document that, but I think all the emphasis was on understanding the euro.
Sudden stop.
I think Patrick froze. It's not just me, right? Okay, we'll go to Charles. A lot of questions were thrown your way, so.
Sorry, we didn't hear the end of Patrick.
Yeah.
Now, first, Galina, I'm going to answer in one word your question about the asymmetric shocks. No, people were aware that you can have a symmetric shock with large asymmetric effects. It was the same thing. I mentioned that yesterday and today because we were basically starting from optimum currency area literature, thinking about monetary union, whereas a lot of policymakers had no clue about this literature, and it was very frustrating. Now, Richard, of course, has a memory that bests my reading of the literature, and he's absolutely right on the safe at any speed report. I should have mentioned that. Now, he started by saying, well, surely it wasn't just the Bundesbank driving the future ECB. There was Lamfalussy and Tommaso Padoa-Schioppa. Well, you gave the answer about the role of Tommaso Padoa-Schioppa by mentioning that. Now, a little bit more detail. When I was one of the authors, and then we had an advanced draft, we went to see Tommaso because he was the contact man for academia at the ECB, or the Monetary Institute. And as you reported, when we got into the room, we got a big dressing down by him. And he said, you can absolutely not mention that. And why not? Well, because this would be the kiss of death of the monetary union. If this goes out in the public, and he didn't say it, but the Germans hear about that, they will give up even before starting. That was Tommaso Padoa-Schioppa, the way resisting to Germany just by not mentioning it. Now, Lucrezia said he gave a speech. This speech was 2 or 3 years later after our report, after he bitched about us, including to the president of the CEPR, then suddenly he started to talk about that. But that was several years later and after a very painful meeting. So you're absolutely right. Now, also Richard mentioned the Endgame report. It was called the Endgame, and I was one of also the authors. I didn't mention it because I thought it was a side story, but we basically came up with a story. You fix the endpoint for the exchange rate conversion, and that's going to stabilize expectation. And I mentioned briefly that when I said ERM 2 after the boiling up was reasonably stable because we knew there was a convergence to some exchange rate that were not defined at the same time. Finally, Beatrice, I very much agree with what you said in the sense that there were lots of debates in Frankfurt and elsewhere, and the debates were seen from today, they may look a little bit silly, but the two-pillar strategy was clearly explicitly not in line with inflation targeting, and after a while the ECB started to accept that maybe somehow they were doing inflation targeting. We heard Andy saying that's the best monetary policy ever invented and it's still in place, and that's what we felt at the time, and that we were very pissed off that the ECB did not embrace inflation targeting, and we're still doing, on the one hand, the monetary pillar, on the other hand, the whatever pillar, and it was frustrating, but it didn't matter because they were just talking, they were not doing it. By the way, the Fed was not inflation targeting at that time either. So there were a lot of hostility to Andy's view, although Andy won the battle by far. Finally, on Patrick, who said, well, the ECB was very busy thinking of the monetary union as a whole and not paying enough attention to what was happening in countries. That really baffles me. Around the table, there was one governor for each country, and I thought it was a mistake I mentioned before, but there were lots of ways for national central banks to signal that trouble was brewing, and they didn't do it. And in fact, I don't think there was an ignorance at the center of what was going on. These were strange times, but I'll stop here.
Thanks, Charles. Before I give a word to Andy, I want to read a couple of comments from Q&A. So yeah. Franz Nauschig is confirming basically what Patrick was saying, that the capital flows were as strong to the Central European periphery as they were to the Eurozone periphery. And then there's a comment from Ted Truman. I never understood the lender of last resort debate. I just assumed that there would be a lender, as there proved to be. So if any of you want to react to that, please do.
I won't react to the capital flows because I am not sure I ever understood this debate. But on the lender of last resort, yes, I should have mentioned it earlier as well in response to Richard. This was part of the Tommaso Padoa-Schioppa being scared, because we did talk about lender of last resort. And what seemed obvious to Ted Truman was total anathema to the European Institute before it became the European Central Bank. And the reason, I think, were that the Germans absolutely never wanted to be seen as ready to bail out those Mediterranean spenders, and they were determined that this won't happen. And that's part of the reason, as Lucrezia mentioned, why the reaction to the debt crisis was so poor for so long. As for what Lucrezia mentioned about 2007-8, yes, but this was driven by national central banks, the rescue of banks. It was really industrial policy mainly. No, she doesn't agree. Okay, fine, let's talk.
All right, so I want to give a chance for Andy, and then Lucrezia, if we have a couple of minutes, you can respond.
Okay, I want to pick up on a point that was made implicitly by both Lucrezia and Patrick, which is the following. During this period of time, the ECB, certainly during all of my visits there, was working on a zillion different things, creating a completely new institution, and the bureaucracy, the operating mechanism, how to model all the various things. That was a difficult and demanding task, especially in a temporary headquarters. And it coincided with a period of time when policymakers spent an increasing amount of time focusing on market signals, right? So it used to be the case, back in the 80s and in the early 90s, that policymakers thought that they knew stuff that markets didn't. But certainly after the 90s and then the early 2000s, there was an increasing focus on taking market signals very seriously. And I certainly remember talking with multiple people, including the chief economist at the ECB, about the fact that long-term bond rates were remarkably similar, as Lucrezia said, across the Eurozone. And this seemed a complete mystery, but the view at the ECB was they know things that we don't and everything that we do, so we should take their market signals, because they're putting their money where their mouth is. We should take that seriously. So there is some degree of hindsight in saying it was clear that troubles were brewing, because there was certainly no indication from the investors at the time that they were nearly as serious as they turned out to be ex post. Thanks.
Okay, thanks, Andy. Lucrezia, we have a couple of minutes if you want to respond.
Well, I mean, I have many responses. Maybe on the land of last resort. I mean, what I mean about the ECB being able to be an intermediary of last resort when the banking crisis phase 1 happened is the fact that it was designed as a central bank with a large balance sheet, with the ability to respond with liquidity association, with an interest rate on reserve, a number of things that the Fed did not have. And the Fed had to adjust to the ECB operational framework, to handle that crisis. So in a way, that was Tommaso was saying, so a modern liquidity crisis is not, is basically an interbank crisis, and we are prepared for that. And indeed, they were prepared for that. They were not prepared to be a fiscal backstop, but that for different reasons, because of that separation between monetary and fiscal, which we all like or liked. I mean, Andy seems to like it more than me, which is the narrow central banking, idea that was the foundation of the Maastricht Treaty. Now, narrow central banking, after 20 years of multiple crises, doesn't really work, so that, and this is one of the issues that, is related to the discussion of quantitative easing and so on and so forth. So I think if we look, about the future, the land of last resort, it's, okay, so I said what I had to say, that, I think on the, another thing, on the financial flows, you may be right. Actually, I'm sure you're right. But the question is, once the crisis strikes, is the monetary union, the fact that then there was financial balkanization and, the consequence of the financial crisis, which came from this kind of large capital flows, which are not just specific to the euro, is that the monetary union turned out not to be, robust to respond to that because of lack of safe asset, because of balkanization, because et cetera, and that became a fiscal problem at the end. Okay, so maybe it's not so much, that the monetary union was the cause, but that combination was particularly toxic. And then finally, on the monetary pillar, I responded on the chat. Of course, we were discussing about the monetary pillar because there was not much else to discuss, but the monetary pillar was not a good system. I mean, I almost lost my job criticizing the monetary pillar because it was not transparent. Okay, it was it was telling people we are looking at the financial sector because we had the monetary pillar, and then M3 has nothing to do with the financial sector fragilities, et cetera. So, I mean, I think it's a good thing that this has been finally scrapped, but, it took quite a long time. The strategy review just finished 6 months ago.
All right, thank you, everybody. We're pretty much exactly on time. I encourage everybody to read Ted Truman's follow-up in a Q&A. And I'm sure we're going to continue this discussion because it's exactly right now we start talking about the crisis. And I pass the reins on to Giancarlo, who is going to moderate the next hour. Giancarlo, you're on mute.
Fantastic. Okay, thank you very much. We just take our breath 1 second and we move to perhaps the Each of the session is a core session of this 5, but this one is particularly interesting because in a way, I thought it would give a, an interesting feel, it would raise an interesting question about how to compare the ERM crisis 30 years ago, the inside baseball, according to Oxford, make the inside baseball more interesting, more open. What did we miss during the last decades that we are learned already in 92, 93, where difference in the structure, difference in the policies, and looking forward, what are the joint lessons for what is left to be done in the construction of the euro. So we just follow the order in the panel, which I lost from my screen. So
Paul is first.
Paul is first, right? Okay. So if you want to go first, I would invite you to really try to be within 10 minutes, so we can have time for debate and discussion.
Okay, thank you very much. Thanks also for inviting me. I would like to share a screen. Can I do that?
Yes, you should be able to.
Okay, share. Oh yeah, okay. Whoops. What is it? So here it is. Okay, so let me just try to be brief, starting by presenting this little chart, history in one picture. This is the last 30 years of spreads of 10-year government bonds in the Eurozone countries. And I started 1990, 91, and today. And the striking thing is the following. During the 1990s, we had foreign exchange crisis, ERM crisis that we have discussed. And then later on, government bond crisis, right? So in the 1990s, there were large spreads that were the result of expectations of future devaluations, necessitating then a spread on 10-year government bonds. And then when the crisis erupted, we got the same kind of spreads, although even higher. So note the following, here's an important point, I think. The structure of this crisis is the same, right? In the foreign exchange market with fixed exchange rates, central banks promise to convert domestic currency in foreign exchange, which they may not have, right? And as soon, for whatever reason, and as soon speculators expect that they may not have the foreign exchange to fulfill this commitment, you get a crisis, devaluation, etc., etc. And now we see that the government bond markets in the monetary union have a similar structure. That is, this is a promise by governments to convert bonds at maturity in a currency which is de facto a foreign currency, and therefore they may not have it. They may lack it. And as a result, when markets expect that this may happen, you get a crisis and spreads explode, right? So it is essentially the same structure. And the nice part of this picture is that when you look at it in more detail, the same countries that had problems in the ERM were attacked regularly are the countries that were attacked later on in the government bond markets, right? And I've done the simple little exercise. I take on the horizontal axis the average spreads during the 1990s. Are they good predictors of the spreads during the financial crisis and the sovereign debt crisis? And the answer was yes, they are relatively good predictors. And it's even better when you look at the surge in the spreads in this year, 2022. Are the crisis, are the spreads of the 1990s good predictors of the recent increases in the spreads in this year, right? And then the answer is yes, it's also a good predictor. So there seems to be an original sin here. Countries that have done bad in the past continue to have problems. And essentially because the structure of the crisis is the same, right? Now, let me focus a little more. I forget the 1990s, and I distinguish here the last 20 years in 3 periods. The pre-crisis period was euphoria. Charles has called that a lost decade. Yes, probably, but a lost decade because of euphoria. Nobody saw it. Everybody thought these bonds are perfect substitutes. You can have a Greek bond in your portfolio, and that's the same as having a German bond in your portfolio, which was an extraordinary situation. And then with the financial crisis, everything changed, right? You can see that these spreads climbed, and in the case of Greece, of course, it was spectacular, but also the other ones. And it took the ECB some time to understand that it should not only be lender of last resort for the banks, but also for governments in government bond markets, which it did in 2012, right? And then you can see how these spreads collapsed. In the case of Greece, you had a new problem, because in the case of Greece, probably the answer was not liquidity provision, but restructuring of the debt, because the country was essentially insolvent. So this tells us that lender of last resort function should only be restricted to liquidity problems. Of course, in real time, it's often difficult to distinguish these things, but here it is. So the ECB understood what was the problem and stepped in, and it disappeared like snow in the sun. So this was a key moment, right, in 2012, when the ECB took on this responsibility. What about the later period? And let me focus on the pandemic now, the more recent thing. This was also a huge shock that hit the Eurozone countries. You may think, well, this was a symmetric shock, but it had very asymmetric influences, right? Here I show the GDP growth during 2020, and you can see the large range of variation of the GDP growth. So there was a strong asymmetric element in that, leading many people to be fearful that this could lead to a new sovereign debt crisis. In fact, it did not happen, right? Here I take a zoom of the same previous spreads that I showed you, the long historical period, but now I concentrate on the period from 2019 until May of this year. In fact, it's June of this year. And then you can see there was a little hiccup after the pandemic, which may or may not have something to do with what the president of the ECB declared at that time, but then it disappeared, right? And then now recently, I will come back to that, with the inflation surge, these spreads are increasing again. So why did the pandemic not lead to a crisis? Well, I think it has everything to do with the new governance that emerged after the sovereign debt crisis, that allowed the European policymakers to use new instruments of stabilization, monetary and fiscal. Monetary was the OMT program that had already been announced 10 years earlier, but also new instruments like the PEPP that made it clear in the market that the ECB was ready to provide liquidity in times of crisis, right? And when fear and panic would emerge again, very much like it did during the sovereign debt crisis. And as a result, the spreads declined very quickly. In addition, the fiscal instrument that you all know, Next Generation EU, was also a game changer in the sense of indicating that, yes, the Eurozone was serious about moving forward towards more unification, and that also pacified the markets. The question then is, that will be my final point, what is the surge of inflation going to do? Is that going to lead to a new crisis, right? Up to now, actually, when you look at the spreads that have increased since the middle of 2021, sorry, they seem relatively small compared to what we have seen in the past, right? But still, it could happen. It could happen because we do know that yeah. Let me not do it differently. Because of the dilemmas that the ECB is facing, and I would argue that the ECB now is facing two dilemmas. One is a traditional dilemma of any central bank after supply shock. When there is supply shock, inflation goes up, output declines. So if you raise interest rate, you make one worse and one better. and you have to make a choice. You have a dilemma situation. If you fight inflation by raising interest rate, you create risk of recession. If you don't want a recession, you risk having a high inflation for a longer time. And these are difficult choices that every central bank faces. Now, in the case of the ECB, there is another dimension which has to do with stability of financial stability, in particular stability of government bond markets, right? That we know are fragile because of the lack of backup. And so here what we see is that the inflation fighting by the ECB leads to higher interest rate, and this tends to have an amplified effect on the long-term rate in high-risk countries. And the question is, if the ECB goes all the way, because now interest rates are still very low, but suppose it goes all the way to fight inflation and raises the interest rate to 3, 4, 5, 6%, why not? This may totally destabilize the government bond markets, right? And so there, the dilemma for the ECB, the second dilemma for the ECB is, shall I fight inflation at the risk of having financial instability, or shall I maintain financial stability at the risk of accepting more inflation? This is an equally uncomfortable dilemma as the first one, but it's very peculiar to the dilemma that the ECB faces today, and also may explain why the ECB has been slower in coming out and fighting inflation by raising the interest rate, right? Is there a way out of this second dilemma? Yes, there is one. In fact, the ECB has announced a new program, the Transmission Protection Program. I'm always baffled by the capacity of the ECB people to find new acronyms, which makes it great for teachers that they have to push the students to learn all this stuff. It is all about lender of last resort, right? And providing liquidity in times of crisis. So it has announced this now and its willingness to do this, right? But of course, if it starts doing this, if it starts systematically buying, say, Italian or Greek bonds, it will create liquidity, which will go counter its anti-inflationary stance. So again, it will have to make a choice. It could get out of this by kind of hedging operation, like hedge funds do, right? You buy Italian bonds and you sell German bonds, right? Thereby also reducing the spreads by lowering the yields in Italy and raising the yields in Germany. Technically, they could do that, and as a result, that would keep the amount of liquidity unchanged, no increase in the money base. The question is a political one. Are we going to, will it be possible to do so? Also, let's not forget that if the ECB does a thing like that, it will actually organize a fiscal transfer, right, from Germany to Italy, in the example that I just gave you, right? So, and it's not clear that there is a willingness to go in that direction. So technically it can be done, but whether the politics and of all this is acceptable, that's another matter. So let me conclude. Will the ECB always be ready to support the sovereign? One can have reasonable doubts about this, right? Who will be at the helm of the bank in the future? The governing council will have different members, and one cannot be sure of this, right? So, and then there will continue to be a fundamental credibility issue, and as a result, the Eurozone will continue to be a fragile construction. Thank you for your attention.
Very well, thank you very much. So we are now, Oliver.
So thank you for inviting me. And since I have only a few minutes, I would like to focus on one aspect of the crisis, which is something that Paul de Gros just talked about. So which is the spreads on government debt and the unstable government debt dynamics that this may imply. So Andy Rose said lots of good things about inflation targeting in the previous session. But I would say that leaving the common currency aside, I mean the euro aside, one could say that the ECB is probably the best incarnation of the ideas that inspired also inflation targeting. So, the main objective of monetary policy is an inflation target, the emphasis on monetary, on central bank independence, and the absolute need for avoiding any form of fiscal dominance and government debt monetization. And so one could say that the crisis is an indictment of the euro itself, creating a common currency, but it could be an indictment also of the ideas that are behind inflation targeting, and that's what I would like to talk about. So when I look at central banks outside of the euro area in advanced economies, including those that target inflation, like the Bank of Japan and the Bank of England, and that's especially true for the Bank of England if I look at recent events, they don't really behave completely according to the textbook views about inflation targeting. So I remember that during the euro crisis, I did a little poll among economists at the US Fed, and I asked them if it came to a rollover crisis on US Treasury debt, would the US Fed let the Treasury default? And I asked this question to a few economists who asked me to swear not to repeat the answer, but the answer was no. It was a unanimous no. When I asked him the second question, which was how the answer to the first question was consistent with ruling out fiscal dominance and debt monetization, I didn't have a clear answer. But I think it's important to think how you can reconcile some forms of contingent fiscal dominance with low inflation most of the time. So I'm going to tell you how I look at this question. It's going to sound like a model because there is a model behind that that you can find in the job market paper of my student Tongli Zhang. But fiscal authorities need time and sometimes a lot of time to implement fiscal adjustments because of political frictions that we observe every day. And this fiscal inertia goes a long way to explain the long waves of government debt upswing and downswing that we see in the data. So by promising to provide a monetary backstop in extremis, the central bank removes the default risk premium and it slows down the buildup in debt. And that gives more time for the government to actually come to a point where it can implement its fiscal adjustment. So in equilibrium, you have a fiscal adjustment almost always before that reaches the threshold where the backstop by the central bank is activated. By contrast, without a monetary backstop, the debt dynamics are destabilized by risk premium and rollover crisis, and defaults occur much more frequently unless debt levels are very low. Now, this raises the question of why the fiscal authorities do not fall prey to moral hazard, right? So once, so to speak, the central bank has their backs, why do they do the fiscal adjustment when they have the opportunity? And the answer must be that they perceive this backstop by the central bank to be costly, and at least as costly as a fiscal adjustment or a default. And indeed, this is a reasonable assumption because the monetary backstop involves not only higher inflation and a durable loss of credibility for the monetary authorities, but also probably the kind of banking and financial repression of the type that has been described by Carmen Reinhardt and others. And this is very costly. And so a fiscal authority that is not perfect, but that is at least reasonably benevolent, would want to do the fiscal adjustment as opposed to a default. So what I have described here is a delicate balance between fiscal and monetary, in which you have this give and take between the two. And I think it's completely missing from the textbook views of inflation targeting. And obviously it was completely missing from the blueprints for the euro area. Now, is it easy or difficult to reproduce ex post? Well, I would argue that it's very difficult, and it's very difficult for the old reason that costs are diluted in a common currency area, right? So I told you the monetary backstop is very costly, but when you have one monetary authority and n fiscal authorities, each fiscal authority is going to pay only one share of this large cost. When you have one monetary authority and one fiscal authority, the incentives are more aligned. And so I think a lot of what we have seen in the euro crisis is a reflection of that tension. Now, there is a lot that I didn't talk about, banking crisis, doom loop, and so on. And I could, if I had some time, I would make the link between this view which I have developed and these other important aspects of the crisis, but I will stop here.
Very, very well. So I guess Geronimo is.
Sorry, Giancarlo, I think I'm supposed to.
Oh, sorry, I'm completely.
I mean, I can speak now. We're all basically talking about the same thing in all.
Yeah. Today I'm having the wrong webinar in front of me, and actually, is of course Paolo who is there. I want, being a co-author and a classmate, I wanted to remove him from my memory bank. Paolo, go.
Sounds good. Let me share the screen and see if it works. Oops, does it work? Okay. Wonderful. So we thought at this point of the conference would be a good time to take a slightly less Eurocentric approach to the Euro crisis. So Otske and myself thought about preparing some notes on the global spillovers of a crisis, of a decade of crisis, and whatever. It's how a native Italian and Turkish economist can do. We'll do whatever it takes, as a wise man once said. The title of his notes, as you can see, it's When Europe Catches a Cold, the Rest of the World Sneezes. And this is kind of an homage to Metternich, that reportedly said something like, when France sneezes, the rest of Europe catches a cold, emphasizing events in one country region affect and influence events elsewhere. And what we thought was to take Metternich's upside down and focus on Europe having already caught a cold, and thinking about how the spillovers from Europe to the US and the rest of the world unfolded in the middle of the period we are supposed to talk about. The section focuses on the Euro crisis from the great financial crisis to Corona. So we thought about going back in time just about 10 years, not the 30 years of the ERM crisis, just 10 years. It's a good time. 10 years ago, 2012, Europe had fought a major cold, if not a full-fledged flu. And as the title foreshadows, the answer is yes. There were negative spillovers. Europe made the rest of the world sneeze. Again, Metternich's upside down. Again, we could argue that things could have gotten worse. If you want to travel back in time to the fall of 2012, at the time, the euro area GDP had contracted about 0.2% in Q3 after falling 0.7%, no growth in Q1, 1.3% contraction in Q4 of the year before. There were asymmetries, there were gains in Germany and France, but GDP in the rest of the euro area declined about 1.2%, and there were particularly sharp declines in the Netherlands, in Portugal, and Greece. And the PMI in October 2012 suggested that annualized GDP decline for coming would have been about roughly 2%. reasons underlying this, as Paul mentioned this before, broad-based weaknesses in consumer spending, capital expenditure. In retrospect, in hindsight, it was a generalized fiscal retrenchment that appears as a key driver of a recession, particularly in the periphery. There was a credit crunch. If you look at the lending service at the time, and at balance of about 10% of banks at the end of 2012 were expected to tighten lending standards over the next quarters, but there had been 5 years of tightening preceding this. And of course, the crisis is translated into major spreads with major asymmetries across countries. One thing to be noticed is that, particularly in the US, policymakers were worried, were concerned about the developments in Europe. I'm taking this quotation from the minutes in September 2012 as a representative statement. Many participants noted that a high level of uncertainty regarding the European fiscal and banking crisis and the outlook for US fiscal and regulatory policies were weighing on confidence, restraining households and business spending. Prominent among these risks were a possible intensification of strains in the Eurozone with potential spillovers to US financial markets and institutions and thus to the broader US economy. The channels of spillovers were the traditional one, trade linkages, cross-border financial flows, as strains on European banks were expected to have an impact on US financial markets through cross-border interdependency, and broadly defined macroeconomic factors ranging from exchange rate and foreign prices development affecting inflation and disposable real incomes, broader confidence shocks affecting financial conditions through equity markets and credit spreads. We are capturing, we decided to have a kind of a stylized representation of these shocks by using the ESG model calibrating to the euro area on the one hand, and the rest of the world. We're using interchangeably rest of the world US because the rest of the world is calibrated on the US. So most of the considerations are kind of transatlantic more than global. We've thought about capturing a match the increase in credit spreads by 180 points, the depreciation of the euro versus the dollar, about 15% in 2012, and using these shocks, putting these shocks into in your Fed global economy model. The model predicts output losses around 2.5% in the euro area at the trough, which is quite consistent with the data if you see the figure above. Of course, the problems were particularly bad in Greece. The adjustment program was off track. Funding options looked politically difficult. There were risks to depositor confidence. There was an open debate on whether Greece would remain in the euro area. And at the time, some ECB watchers, Citibank in August 2012, as a representative one, was estimating the probability of Grexit in the next 12 to 18 months at about 90%, and increasingly risk that Grexit would occur in the next 6 months or so. So this did not happen, but it was certainly a risk in the mind of people at the time. And if you want to use this kind of considerations to address the consideration about spillovers from Europe to the rest of the world, we're watching in real time what happens in England, and this can be a good exercise, a good cocktail napkin exercise to think about risks going forward. So if we return to our DSG model, we model Grexit pretty much taking the great financial crisis and using this as a benchmark, as a paradigm for what could have happened, and to build a counterfactual Grexit scenario. It's a larger and more persistent increase in credit spreads, so affecting financial conditions in the euro area more drastically, more severely, and a greater and more persistent depreciation. The euro depreciation, credit spreads, it's pretty much what we see during the GFC. And you can see the results here for the shocks and the real effects on Grexit according to the model. The model would predict that if Grexit had materialized, if a bad scenario had materialized, we would have had a 5% annual decline of GDP at the trough, which was twice as large as the decline observed in 2012. The decline would have been quite persistent. So, and this is probably the core of our notes. Let's talk about how this would affect the rest of the world, the US, the rest of the world. We have a baseline scenario, which is pretty much based on the data. So here we're plotting the shock minus control. The zero line is what would have happened without the euro area shock, and the baseline scenario is the blue line. Overall, considering the different channels, there is a trade channel, the dotted line, concentrating on trading final goods. There is a line where combining trading final and intermediate goods, that's the dashed line. And then we talked about the trading financial channel, that's the combined effect. We get a baseline scenario where the prediction of the model is spillovers were negative to the rest of the world, the US. It was a reduction in GDP growth by about 85 basis points, which we think was mostly operational through the trade channel. The reason was that we think that's what the model suggests, that the actual effects of financial interdependency through banking strains were more limited. Most of the action was actually through trade in intermediate products. However, if a Grexit scenario had materialized, if a counterfactual breaking bad scenario had been operational, then weaker growth in the euro area, stronger US dollar would have reduced growth another 85 basis points, more or less. Once again, through lower intermediate goods exports, but now all the channels are operational here, and the financial channel in particular would have had larger, more persistent effects. The US banking sector would have experienced more equity losses through their exposure to European banks with tighter financial conditions in the US. So overall, we think that GDP growth would have been 170 basis points, basically almost 2% point below the no-shock path if Grexit had occurred. And you can look at a little bit more in detail about the different sources of spillovers. On the top, we see still the effects on US GDP growth that was basically almost 2%, would have been almost 2% below what actually turned out to be the case, through a combination of US credit spreads and tighter financial conditions, and mostly because of the falling growth in the euro area by about 5% of a trough would have imparted a major negative impact to US export growth. So ultimately, what did the euro crisis mean for the US and the rest of the world? At the time, then, and perhaps now, it depended on the nature and modalities of adjustment scenarios going forward. Grexit did not materialize, and the spillovers ended up being negative, but relatively contained, perhaps not muted. After all, it took up till the end of 2015 for a lift of the FFR to materialize. So we had certainly negative effects that weighted on the outlook for output and inflation in the US for quite a while. And most of the spillovers were related to a slowdown in trade in intermediate goods. We think that financial spillovers were relatively limited because financial institutions, by the time after the GFC, had reduced their exposures and held more capital against remaining exposures. But the implication of more disruptive scenario, like Brexit, were certainly subject to extreme uncertainty at the time, and God knows whether this is food for thought for future or current episodes. So the US sneezed, could have been pneumonia, and I'll leave it at this. Thanks.
Thank you, Paolo, I guess, for reminding us that, thank God, we should be thankful that the EA did not punch above his weight at the time, but you remember there were many expressions of concern about the potential consequences of the structured Brexit, not the beginning especially. Lorenzo, I guess, at this point, I'm back on my own.
Thank you. I hope you hear me. Thank you very well. Thank you very much for inviting me, having lived through these 30 years in various capacities. And as was mentioned yesterday, and maybe also today, a special thought to those who have contributed to a better understanding of what happened during the last 30 years and before, which are not with us today. Being nearly at the end of the conference, I was thinking, what to say differently from. And I started, I put myself in somebody in 2050, I don't know, looking at the history of Europe, not only from a purely economic profession point of view, and asking myself why is 1992, 93 crisis important, and what have the following debates contributed, the following decades contributed. And I think the key issue in my view, which is most relevant, is a history of central banking and the position of central banking in society and its relationship to politics, to the political environment. 1992 crisis is relevant because it's the end of a central bank, basically, or it's the beginning of the end of a central bank, and maybe 93 crisis is more relevant. But it became clear in 1992 that Europe could not be ruled by the central bank of one country, even if it was the most successful and the most credible one. And the reason is that first, for the first time since the EMS, the shock was at the core of the system. It was not a shock in one of the other countries. And the second element is that the history of the EMS showed that exchange rate adjustment had political costs. And we knew this in 93 in France and in other countries. And we experienced this, if you reread the history of September 92, starting from the ECOFIN meeting, and especially having made public what happened in that ECOFIN meeting.
Oh. We have a problem. Hopefully we'll come back.
It was not supposed to be made public.
Let's wait another few seconds to see whether he can come back. No? It happens sometimes. The end of the central bank, I guess, was too strong. It's actually.
I presume he's had a problem with his internet. I have resent him the link up and he's joining again. He is just arriving back. Lorenzo? There we go. We can't hear because you're on mute, but we can see you again. I would suggest if you are having any problems with your internet, if you turn off your...
No, it's okay. I just, my computer broke down, so I'm using my iPad.
No problem. All right.
Can I continue or you?
Yeah. I
Sorry. No, I'm sorry. So no, I was saying it appeared that the European Union would be at a crisis if it was based only on one central bank. I think what happened in September, and especially I think in 1993. Why I'm saying this? Because what, with the benefit of insight, the exchange rate of the French franc and Deutsche Mark that was put into question in 1993, in fact, was that same exchange rate which led to linking to the euro. So it was the equilibrium, the right equilibrium rate. So I think that signaled, even though the Maastricht Treaty had been signed already, but nobody really believed that it would be implemented. I think Helmut Kohl said that it would happen, never happen in his lifetime. But I think the crisis of 92 and 93 clarified that the institutional framework for managing money, and money is political, was not appropriate. So it started, I think, the transition to building the European Monetary Institute, and then the ECB, which I think, contrary to what others said, was indeed very much copied on the Bundesbank to inherit its credibility. I mean, the monetary pillar, as Lucrezia reminded, was built on the Bundesbank. And I think in the end, if you go to the next crisis, 2011, 2012, basically was largely due to the fact that the ECB was built on the Bundesbank model. In particular, the key point one was no supervision of banks. If you remember, the Germans had this system, this division of responsibility, even though the Bundesbank was involved in practical terms, that had no responsibility. And that was a key limitation for the 2011 and 12 crisis. But the lender of last resort with respect to governments. And the key change there was not that Mario Draghi was suddenly saw the light and realized that, as Paul said, the ECB understood that it had to say whatever it takes. But the key change was that he had the endorsement of Angela Merkel. It is that there was a key institutional change in 2012, whereby the ECB was recognized the role of lender of last resort in the government bond market. And that was a key change which allowed the ECB to say, to adopt the OMT, which of course included many conditionality. Now, 2022, after the pandemic and the acceptance by governments that they should play a role in supporting the economy after the pandemic, and the adoption of this TPI, which basically is an ex-ante conditionality, is the beginning of a new era, and we will see whether this will be sufficiently strong from an institutional point of view to manage money for Europe in a way that reduces shocks or allows a better absorption of shocks. I'm sorry for having dropped off, and I will conclude here. I agree with Paul de Grauwe that the construction is still fragile, not because it will depend on who is the next president. I think that we are still having an incomplete union, although it's much stronger than at its beginning, and it is stronger than in 92 or 93 when the MS crisis, thanks to the experience, as you know, and as Monet used to say, Europe progresses through crisis. And I think looking backwards at the history of these last 30 years, in the end, Europe was able to strengthen the monetary construction and to make it more accountable and better anchored in a political environment which is changing, because the political union today is different from the political union of 30 years ago, and we may expect this to evolve further. And it is important that the central bank evolves in link with this evolving political change. Thank you.
Thank you, Lorenzo, not only for being right within the time, but throwing so many important questions and issues onto the table. So any questions from the panelists? Otherwise, I'll voice one question from the audience concerning the fiscal transfer from south to north as a rebalancing, given the initial transfer of fiscal capacity created by common currency. This is Enrico Perotti. So the idea that the common currency, you devalue, you keep the exchange rate weak for the core countries, overvalue exchange rate for the periphery, and the fiscal transfer north to south is part of the necessary required rebalancing. I don't know whether any of you want to react to this. Otherwise, I also elicit questions, I think, quite a bit on the land dollar resort, or the way I would like to call it, the monetary backstop by the central bank. The possible functional monetary backstop to create space for fiscal correction. That was a question by Olivier. And the, of course, possible potential global systemic effect coming from the euro area, and this view of the evolution of the graduation, redemption, development of the ECB from the early connection to the history of the German central bank as the core monetary leader in Europe. Anybody wants to go first? Otherwise, we go backward. Paul?
I can talk about, yes, so the I think the terms lender of last resort is a little bit misleading in this context, because it evokes multiple equilibria and free lunches, right? So like in the diamond deep dig model, for example. The way, so I don't think these exist really, but the way I think about it is more that there is a choice between maybe having higher inflation and what we call the monetary backstop once every century versus having a default once every 20 years, right? And maybe if that's the choice, it makes sense to choose to have inflation once every century. And by trying to reduce this probability of inflation to 0%, so going from a very small probability, very small frequency to literally zero, you have to pay a big cost in terms of instability of government debt markets. So I think this trade-off is a bit different from what you find in the traditional theory of the lender of last resort for banks.
Charles has raised his hand. Would you like to come in, Charles? I see that also Paul has unmuted himself. Charles? No, maybe it was from.
I'm coming. Okay. No, I wanted to ask a question about the picture that Paul showed. This classic picture of interest rate spreads that disappeared during a period of the monetary union, then reappeared and disappeared again and reappeared. I think there are two stories about that, at least, and I'm not sure what is the right one, and Paul can tell us or others. One story, well, when the interest rates all became, the spreads disappeared, if you want. One story is that it was a multiple equilibrium story. People believe that we had really one currency, this has been destroyed. This belief has been destroyed with the debt crisis. Another story is that there was a time when the ECB was buying public bonds, treasury bonds, from all countries, or using the same kind of collateral policy. So the ECB was the absorber of all public debt at a fixed interest. It was basically bringing all these interest rates together, guaranteeing this interest rate to be the same. And somebody reminded us that Jean-Claude Trichet was complaining about that, but he may have been the culprit. Now, when they moved separately during the crisis, that's when the ECB started to distinguish between treasury bonds from different countries, and it hasn't stopped really, or it hasn't, it's linked to the lender of result discussion. It hasn't said that he would bring this interest rate, he wanted this interest rate to be equal. Now, what is the answer to the question, multiple equilibria or policy changes at the ECB? It matters a lot, of course, in the current time, when we have these spreads again going up and down and up. So I'm happy to know if people have a view on that.
Very good. Would you like to respond on that, Paul? Or
yes. Well, I think my view on this is that, and I tried to formulate it in the beginning, that the ingredients of the foreign exchange crisis that we experienced in the 1990s were the same as those that we would experience later during the government sovereign debt crisis. Basically, the instability of commitments that policymakers make shifted away from the foreign exchange market because they ceased to exist to the government bond market, right? And some governments make commitments that are not credible, and then they will be attacked, and that's what happened. And so I do believe also in the story of multiple equilibria, because what we have seen during the sovereign debt crisis is that although it was clear that in the case of Greece, this was an insolvent nation, right? Or insolvent government, sorry. It was not clear at all that this was the case for Spain, for Ireland, and a few others that were also attacked by speculators. So these were solvent nations, right? But they were attacked very much like in banking crisis, right? Banks that are solvent can be put under pressure by deposit holders that just are panicking. They are panicking, and then they run away, and something similar happened. And that's a model of multiple equilibria, right? It just depends. The equilibrium you will be in depends on your beliefs. If you believe a particular government will be in trouble, will be illiquid, which is a possibility if you have no backup, that is sufficient to trigger an attack. And so you get multiple equilibria. So I do think that this is the simplest possible explanation. I mean, we can find other ones, but let me invoke Occam's razor. This is the simplest possible explanation. And yeah, so that I think that's, I see that.
Paul, Patrick would like to come
Patrick,
in.
oh, sorry, yeah, okay.
Thank you, Paul. Patrick.
Yeah, 2 points. On this particular point, I agree with Paul, but I want to add one other point. I think that the Draghi intervention, it took away the breakup risk, the exit risk, but it did not take away the default or debt restructuring risk. And that's why the spreads didn't come down to absolutely zero. And that's why, as Paul says, every time something bad happens, they blow out again, and they blow out bigger for the more vulnerable countries. I think that the default or restructuring risk is still in the system and has not been eliminated by what the ECB did. And just a point out, Charles says the ECB decided early on to accept and buy government bonds, no matter where they were. But actually they didn't. They accepted as collateral government bonds depending on the rating, the credit rating agency's rating. And of course, they were all very high ratings, so they accepted them. But it's when the ratings went out, the ECB then got caught in this situation where they had decided what the ratings were going to be, and that suited some people who felt that the ECB shouldn't be taking credit risk, and didn't suit other people. Athanasios, he goes on and on about this, about the fact that the rating agency's assessment was baked in at an early date, and that created an automatic issue when the ratings for Greece and Italy and so on deteriorated.
Thank you, Patrick. There is a
question. I don't know. It's Lorenzo.
I wanted to invite
no,
you.
Sorry, I don't know how to raise my hand. No, I would suggest, Paul, to look at the US market for ratings that are similar to the European government bond markets and the spreads in the US market. I think in those years, in the years 2000 until the great financial crisis, you had this compression of spread everywhere in the world, not only Europe. And you had rating agencies which were giving high ratings to everybody. So I think it was a phenomenon that I think goes beyond the European situation, that simply markets were assuming convergence and they were playing convergence.
May I bring in a question by Ulrich Schroeder? So I would like actually to answer the question, which is one thing that is often forgotten, that the effectiveness of a central bank to intervene rests on its credibility, meaning that you cannot have a central bank without monetary credibility to intervene and calm the market. So this is something that people, so it's not that we are talking about different objectives. Now, of course, there are two important aspects that Olivier Jean raised, the fact that there is a game over time. So sometimes the central bank needs to create time for correction to happen. But at the end of the day, there is no real effective intervention if stability, fiscal stability is not restored or is not guaranteed. Central bank cannot create fiscal stability. They can provide time for correction. They can help. And in this, I think also the lessons from Lorenzo about the political side of monetary policy is very important, because that is always there. Sometimes we forget about how important the political side of monetary, not only in Europe, not only in Europe, also in other countries. Paul, we have like 1 minute.
Yeah, no, on this note, on credibility of monetary policy, and going back to Andy Rowe's comments earlier about the evolution of a monetary framework, starting from exchange rate targeting as the key of a nominal anchor, moving to inflation target. I'd like to emphasize how the framework has evolved both in the US and in Europe. with elements of average inflation targeting in light of experience with an environment of low or negative equilibrium ourselves. The situation has evolved. We are now facing another test of the credibility of central banks in the commitment, in the whatever it takes to fight inflation. And one of the questions that I think maybe the next panelist could focus on is whether the current monetary frameworks in the transatlantic economy are appropriate to deal with the implications of the last round of global shocks, and perhaps whether the credibility of central banks are now once again tested by markets, and whether another evolution of these frameworks might be warranted in an environment of high persistent inflation. I'll leave it at this.
We need, I guess, to close this. We are 1 minute late, but I now hand over to the capable hands of Beatrice, the next final panel. Thank you to all the panelists for this session.
Thank you also from my side to all speakers and panelists for still being with us for this last and culminating session about the next decade. So we have heard over 4 hours how the last 4 to 5 decades have evolved. We have had a lot of people that were actually involved in the making of the monetary history of Europe. Definitely many that have been involved in its analysis. And it would seem to me that there is a quite large convergence in the analysis of the history. Now, by the fact that we are not knowing, we don't know right now what is ahead of us and what the next decade will bring. This is obviously a much, much more open session. We have only 3 speakers whom I also ask to please restrict their comments to 10 minutes each. That will leave us a bit more time for discussion and for other views that might want to be shared. So have we learned the lessons from history? What is the next decade bringing? We are certainly starting the decade or started the decade from a very difficult position with a pandemic, inflation and energy and a security crisis in Europe. There are lingering questions of monetary, of how to think about the monetary architecture. The question that was just asked by Paolo, is it fit for next shocks and for the next period? And there is also the lingering question about how to think on the interaction between monetary and fiscal, and how much of the old Maastricht thinking has de facto should prevail or should be revised. So we have 3 speakers, and they are all very, very well equipped to think about the future. Martin Sandbu from the Financial Times has been very influential in doing broad think pieces. Jeremy Sedlmeier, who is back in Europe, welcome Jeremy, and has taken over as head of Bruegel recently, and Francesco Giavazzi, who has been at the steering wheel in the Italian government, and now hopefully will have soon more time to be with us and CEPR more frequently. So I ask you to please give your comments, starting with Martin.
Thanks, Beatrice. Can you hear me? This is working?
Yes.
Very good.
Yes, we can.
Thanks for having me. It's just nice to be virtually, at least, together with old friends and interlocutors. Well, it's a very sort of broad brief you gave us to kind of look into the future. So this will necessarily be very speculative, but that will hopefully make for some good discussion afterwards. I mean, I've tried to in terms of thinking about what to say, I've been trying to think about what the whole, the starting point of the discussion, the ERM crisis, what the underlying phenomenon there was, what that tells us, or how that frames how we can speculate about what may come next, or what the big issues are in the decade to come. And where I want to start is probably a bit more radically than what most people have been willing to say. I mean, we've heard from several speakers in many ways that the underlying challenge that manifested itself as the ERM crisis 30 years ago is the same as what manifested itself as the Eurozone debt crisis 20 years later, 10 years ago. And that after monetary unification, really most dramatically took the form of the questioning of the integrity of the euro itself, the possibility of breakup. That is the current version, if you like, within a monetary union of the tensions that led to the ERM crisis, and of course all the debates coming before that too. So I want to start with the claim that the singleness of the currency, currency union, that is by now become an uncontested key. The doubts about the integrity of the euro are behind us. Look at I will count them as three crises over the last 2 years: the pandemic, obviously, the energy price shock, and not quite a shock, but something different from the energy prices themselves, namely how monetary policymakers address the monetary disturbance that those energy price shocks caused. In each of those, I see no serious political attempt at saying that the euro itself is a problem in any of that, and that being without the euro would somehow have been better. No questioning of the reasonableness of monetary unity. I think that's quite significant, and it's a great victory. So that's kind of my starting point. I think that means that basically the future of the euro is safe. No country will leave. More countries will join. Croatia is on its way in. We will see other countries join in due time. Within a decade, I think we can see certainly a Euroizing Ukraine, if we win the war, at least. Now, why do I think that this is basically a battle that's been won? Well, a lot of it has already been touched on by previous speakers. The monetary union, of course, now has acquired new mechanisms for risk sharing that weren't there before. Those were consequences of a push for political unity in these crises I've just mentioned. So you can think of both the Next Generation EU construct or the sure refinancing of unemployment insurance construct as new mechanisms for fiscal risk sharing or macro stabilization in the case of asymmetric shocks. That's one element. The ECB has become a normal central bank over the last 10 years for a number of reasons. Partly it's basically aligned to what other single nation central banks do, being a lender of last resort, accepting those responsibilities, adopting standard symmetric inflation targeting, and so on. Another aspect is that other central banks have become a little bit more like the ECB. We already heard mentioned the issue of operating with a large balance sheet as the standard operating procedure. And of course, every central bank has become a little bit more like the Bank of Japan. So there's been a convergence there, which again makes the ECB a little bit less of a strange creature. We now have a common safe asset that we didn't have before. There's not a lot of it, but precedent is a very powerful thing in politics. And having created a Eurobond once, we're not going to get rid of it. But above all, there is political unity. These last couple of crises, unlike the Eurozone debt crisis, have really reinforced political unity. I think that's at the bottom of it. But even the inflationary, you could say that the Eurozone debt crisis, because it was a monetary crisis of the euro, if we had that again, we would start to get a fissile situation. But you look at the inflation crisis, the current inflation crisis is a monetary crisis. And yet, the question of euro membership just doesn't come up. And I think a useful illustration is to compare Czechia and Slovakia. pretty similar inflation rates. Czechia is a bit worse. Of course, Czechia needs inflation rate, interest rate, policy repo rate of 7% versus the 1.25% in the euro area. It's just an illustration of how there's no longer any point for anyone in trying to say there's any attraction in leaving. Now, what is instead contested or contestable then, because I think the history of monetary vociferousness, I want to claim, is over. What that instead opens are, I think, three areas of contested questions or policy challenges. One is the conduct of the actual macroeconomic policy within the euro. We heard a lot about inflation targeting. I think we are about to see it come under some pretty strong political pressure if it is perceived that the ECB goes too far, tightens too much, and causes an unnecessary recession. There will be issues about fiscal monetary cooperation that will put the traditional framework again under strain. I think there will be a strong need for some intellectual innovation, very much like we saw in the 1980s with central banking and monetary theory then. There is, of course, the whole issue of the climate transition and how central banking addresses that. All of those are elements of monetary policy that will be contested. But the point here is that these are the same as the ones that monetary policymakers face everywhere. And I think that's true of the financial stability issues as well. So here I want to differ a bit from Paul de Grauw, because I think what is striking about the risk of increasing spreads, widening spreads, and how the ECB will have to tackle that financial instability danger. What is striking about it isn't how idiosyncratic it is, but how similar it is to similar problems faced by other central banks. And of course, we see it with the Bank of England, where some built-in instability that most of us weren't aware of was triggered by a surprise rise in yields that turned out to then feed on itself. We know from recent reporting that the Federal Reserve is worried about exactly the same thing. Of course, we had a flash crash in treasuries only 2 years ago. These are really very similar processes. And we could go back in time too and think about the Eurozone debt crisis, some of which was due to, or at least worsened by, the same mechanical dangers that we see in single nation currency areas. I'm sure Patrick Honohan can regale us with stories about how LCH ClearNet was increasing margin calls on Irish sovereign debt. And that was part of what drove those spreads up and caused political panic and the ECB and the IMF's arrival in Dublin and all of that. So there are just many more similarities than there are idiosyncrasies. So conduct of monetary policy is one big area. The second is, now that we have a unified monetary area in the Eurozone, what about the optimal performance of the Eurozone economy? I mean, that obviously is a problem that never goes away. And very often I find that people talk about the functioning of the euro when we're really talking about the performance of the Eurozone economy, which are conceptually very different things. But they are related. And they are related in particular where in practice, the unity of money is not actually complete. So we see that with the national fragmentation of parts of the banking markets, the lack of banking union in many aspects. But in particular in retail banking, these are still very much national markets. Try to set up a bank account in a country you don't live in, even within the Eurozone. The fact of undersized Eurozone-wide capital markets is part of that. These can all be seen as an incomplete uniqueness of the euro across national jurisdiction. But I would also put in here that the promise of monetary unification and ending currency instability within the Eurozone is also linked to the fragmentation of the single market in product and service space. And a way of thinking about this theoretically is to say that to the extent that different currencies were a constraint on trade and economic integration, if that constraint has been lessened because of monetary unification, other constraints have then started to bind. So in a sense, the promise of the euro is limited because the other parts of the other things that fragment the single market have not been fixed. Regulatory differences, remaining regulatory barriers, language barriers, cultural barriers, corporate law, and so on. Finally, the third sort of remaining big contestable issue is the international role of the euro. Here, of course, there's a policy objective in the EU to make the euro more widely used internationally. That policy preference, I think, will surely get stronger. It was motivated in part by sanctions policy to begin with. We remember Iran and Instex and so on. But this will surely get stronger as we gain experience with financial sanctions on Russia, now with US chip sanctions on China, which have extraterritorial reach. And the monetary dependence on the dollar, of course, is extremely visible these days with a new turn in the global financial cycle caused by the dollar and the dollar's dominance, meaning that other currency areas, including the euro, suffer much more from dollar instability than does the US itself. Now, will it work? Will it be possible to increase the international role of the euro? Well, it depends how much European policymakers try to make it happen to some extent. They have better prospects now than before. There is now a safe asset. There will surely be more work done on new energy price benchmarking, but the real game changer would be if it's adopted a central bank digital currency. I tend to believe that there's a first mover advantage in this space. The euro or the ECB is quite forward on this curve. I think it would clearly make the use of the euro as an international transaction currency more attractive. And domestically, it would help to overcome the problems I mentioned before, bank fragmentation along national lines. A programmable CBDC in particular would help deepen capital markets, I think. So all of this would help to make the euro a more attractive reserve currency. But I put these out as questions for what will happen next. I think these are the important ones.
Great, thank you very much, Martin. We go over to Jeremy right away.
Thank you so much. And thank you so much for inviting me for this. It's been super interesting. It's a great honor to be part of this crowd. Okay, so I'm going to organize my remarks around what Giancarlo yesterday at the end of his presentation in the first session referred to as the Ottmar Issing question. I have no idea whether Ottmar Issing actually asked that question, and he's here with us, so he cannot tell us later. And so to remind you, this is the following question. What is the minimal economic constitution required for the euro to deliver stability and prosperity? And I think the sort of implication of that question, and I checked with Giancarlo this morning by email, is whether this minimal economic constitution falls significantly short of fiscal federalism or not, or whether you need to go to full fiscal federalism. And then to inject the next decade perspective of this session, I want to ask the question, will we finally get there in the coming decade? So before I answer these questions, I just want to define some terms. So I will interpret stability in Giancarlo's rendering of Ottmar Issing's question along two dimensions. First, the absence of disruptive crises like the ERM crisis or the euro crisis. And secondly, as a macro stability in normal times, so the ability to conduct stabilization policy. And I will interpret prosperity along the lines of what Giancarlo and others mentioned as one of the original motivations of the euro, namely whether it helps create a genuine single market for both goods and services, and of course, importantly, including financial services. So will it give rise to financial integration in the style of the US? Okay, so this session is about the future, but I can only look into the future by looking into the past. And so I will go a little bit and I think construct what I perceive. So it's my sense, I may be completely wrong, as sort of the original answer to the Ottmar Issing question by the framers of the euro, and I'll do it in a caricatured and stylized way, and forgive me for that. So on the stability front, I think there were three 3 points that were kind of implicit in the original design. First, the euro would be good for stability because the outsourcing of monetary policy to a highly independent central bank, plus the removal of the monetary punch bowl to governments, would remove a key source of boom-bust cycles and, consequently, first-generation currency crises, fiscally engineered currency crises. Second, unlike the ERM, the irrevocable peg would also remove the possibility of second-generation currency crisis inside the euro area. And in order to do this, one really needed to add nothing in terms of, underlying economic constitution to the creation of the euro, except for making it very difficult to exit. And this happened by linking euro exit to EU exit. And so in that sense, in the original design, the only sort of perceived remaining stability issue was that monetary policy was no longer available as a policy instrument. And that means there's a greater role for fiscal policy. At the same time, fiscal policy needs to be constrained because of externalities, dead externalities within the EMU. And so reconciling these two principles fell to the Stability and Growth Pact. And basically, the general idea is very persuasive. You can reconcile all these things if you build sufficient buffers. And if you have sufficient fiscal buffers, you can use fiscal policy when it is needed for stabilization purposes without creating a debt problem. As far as the prosperity dimension of the question is concerned, I know less about it, but my sense is that the removal of trade costs and restrictions, and of course the preceding removal of capital controls, created the view that the removal of the trade costs induced by exchange rate fluctuations were viewed as a sort of an automatic driver of greater economic and financial integration. And so, in this maybe overly caricatured original vision, the only economic constitution that we really need to beyond the creation of the euro itself is the Stability and Growth Pact and little else. Now, it didn't work out that way. So what happened? What went wrong? I think you can put it into two classes. So where the obstacles to stability and prosperity had been correctly identified in this original diagnosis, some of the original assumptions about how the obstacles could be overcome proved incorrect. But then importantly, and perhaps more importantly, we discovered some obstacles that had not been anticipated. By we, I guess I say most of us and possibly the designers of the euro, not the CEPR authors of the 1998 Safe at Any Speed report who anticipated some of these obstacles. So maybe a few words on each. So with respect to our original assumptions about how the more difficult aspects of euro could be navigated, most importantly, the SGP failed. It failed mostly because it was not implemented. It was not implemented because the political economy of building large buffers is incredibly difficult, and there are insufficient incentives to follow the rules. Plus, there were some design issues. But basically, I view it mostly as an intrinsic problem that we are still grappling with. And then finally, of course, the assumptions that the removal of exchange rate volatility would per se be a major driver of integration turned out to be incorrect, at least in a structural sense. So it was the driver of an initial boom, but after the boom came to an end and we went through the crisis in the bust phase, clearly integration wasn't there, particularly in the financial sector. And then on the sort of unanticipated obstacles, we have just discussed it in the previous crisis. I mean, the first is we discovered a whole new set of crises, which, by the way, were well known in emerging markets, but not in Europe, that were not on the radar when the euro was created. So most important, the possibility of boom-bust cycles from involving center-periphery capital flows, so sudden stops, attacks on sovereign debt markets rather than currencies, and banking crises with a cross-border dimension. We discovered that losing the national capacity to print money, while it reduces opportunities for mischief, it also reduces opportunities to react to mischief. So the point driven home by Paul de Grauwe in his 2014 paper and in his presentation right now. The fact that borrowing in a monetary union with a highly independent central bank with a pure price stability mandate is a bit like borrowing in foreign currency, the point made by Paul today and by Olivier as well. And finally, the discovery of the doom loop between banks and sovereigns, both as a driver of crisis and as an obstacle to financial integration. So how did this then change our perception of that minimal economic constitution needed to make the euro work? And so, you know, the post-euro crisis vision to a first approximation was a significant upgrade from the original vision, but it retained important elements. So what were those elements? A reformed SGP, plus some BOP and fiscal crisis prevention and resolution institutions, so the OMT, the ESM, now the TPI, plus banking union, and ideally capital markets union. So what are the lessons from the last decade, and the lessons that are sort of pertinent to the question, is this indeed the minimal economic constitution that we need, and are we likely to get there? So the main lesson is that we still don't know whether it would work with all these elements in place, because we are very far from actually putting them in place. So the implementation of that sort of, you know, Mark II vision of the minimal economic constitution has been incredibly difficult, particularly on banking union. The doom loop is alive and well. Banking crisis management remains largely national. Financial integration remains far below the US standards, and there's no meaningful capital market union. And now, why is this? And so here, my conjecture is that this is the case because fiscal policy remains overwhelmingly national. So clearly, the failure of Germany and Italy to come to a deal on banking union last summer, in spite of, you know, great efforts of the Eurogroup president, is due to that, right? It is Germany's fear of fiscal transfers via deposit insurance, and Italy's fear of rollover crisis, leading it to reject any regulation of sovereign exposures. And similarly, you know, obstacles to capital markets unions have to do with national differences in taxation and insolvency regimes. The US example shows that they don't have to be perfectly aligned, so you don't need, like, you know, full centralization of taxation, but they must be much better aligned with a much greater role for the federal level than we have now. So if this conjecture is true, then, you know, the reason why we only got halfway through the post-crisis EMU agenda, because it's mostly fiscal. You know, on the fiscal integration front, very little has happened. Then the question of whether this SGP plus banking union plus crisis and mitigation instruments could be a minimal alternative to fiscal federalism is a moot question, because making that minimal alternative work may actually require fiscal federalism. So what are the implications for the next decade? Fiscal integration is clearly a super tough nut to crack in Europe, because it's intrinsically linked to national sovereignty and democracy. The RRF surprised everyone. We thought for a minute that maybe this was some sort of Hamiltonian moment, but clearly it was not a permanent game changer in the direction of common borrowing for both political and legal reasons. And as a result, we probably will never get to the, quote, minimal economic constitution required for the euro to deliver stability and prosperity in the sense that I tried to define at the outset. So the EMU will deliver some stability and prosperity based on the improvements that we've already achieved, as well as some incremental improvements that we can still manage, consistent with the lack of significant additional fiscal integration. And so, we can by all means have better fiscal rules. The Commission is trying. There's supposed to be a new proposal in a few weeks. We can have some common borrowing and spending for specific purposes, such as defense and green transition, and we can hopefully overhaul European level bank resolution and crisis management. Now, the question is whether this sort of very
Chairman,
improved.
sorry, are you closing?
Yeah, I'm closing. Is it better than the alternative of monetary independence plus institutional improvements at the national level? So essentially the path that the UK took. It's not fully clear, right? So my intuition is that it is superior. What we will have, what we have now, arguably, is superior in the sense of greater resilience to normal domestic policy failures and political shocks like populist regimes across a fairly wide range of such shocks. But the consequences of a very large domestic policy failure and a political shock could be much more devastating. And so the example here is, if you look at what happened in the UK, of course, very big costs, very embarrassing for the UK, but UK political and economic institutions ultimately absorbed the shock. It may well turn out to be a blip. And now think of something like this in the Euro with, say, a populist right-wing government coming to power in France, trying to pull a Liz Truss on France or declaring economic sovereignty by issuing a parallel currency. So this is much less likely to happen precisely because there are additional checks and balances, additional institutional constraints in the Euro area. But if it does happen, the consequences would be much, much more disastrous than what happened in the UK in the last few weeks. Let me stop.
Okay, thanks a lot. So that was a more somber note than the one we heard from Martin. Francesco, you are next. And please, if you can do 10 minutes so we have some time for discussion.
Thank you. Good afternoon to everybody. Yes, Beatrice, I'll say something precise and brief. I won't maybe take 10 minutes. I want to start from a graph. Let's see if I can show the graph. Share screen. Okay, so this is the legacy of QE since 2014 and PIP since 2020 on the balance sheet of the ECB. So this is the share of sovereign debt of individual countries now held by the ECB, that goes from 20, France on the low side, to Germany, Italy, which is close to 30. Now, this I think is a problem that needs to be solved because makes the ECB a different central bank from what is a normal central bank. And in the moment where the ECB is considering or might consider using monetary policy to address inflation, although I personally think that monetary policy is not today the right instrument, but I assume the ECB does it, what will be the consequence of the large holdings of sovereigns in the balance sheet of the ECB? Just go. Okay, so what we did, this is a notes or a paper written with Veronica Guerrieri and Guido Lorenzoni. So what we did, we took the WIO, the October WIO, and tried to extend it in a way that I'm going to show you in a moment, and asking ourselves what would be the effect on that dynamics. And we do look at the case of Italy in the current situation and in a situation where the sovereign debt now held by the ECB were transferred to a European debt agency. This is an idea that has been around some time, and as we will see, it makes obviously significant difference. So this is what happens to the debt to GDP ratio. So up to 2022, this is the baseline of WIO, and then you have three scenarios. The green is WIO, and the red and orange are two scenarios with high interest rate with and without a spread. So how do we extend this beyond 27? So up to 27 is WIO. From 28 onwards, you have to make assumptions to what happens. So we assume that nominal growth is at 3%, which is the assumption made up to 28. and that the primary balance remains at the 2027 level, which is a surplus of about 0.6% of GDP. The cost of debt, the 10-year interest rate on Italian bonds as today, some of a safe rate and a spread, and then there are two possibilities. One where the spread remains at 150, this is the brown scenario, and one where the spread goes to 400, which is the red scenario. And then you have to make a few more assumptions about interest rates. Now, okay, so this is essentially all that I want to tell you. These are various paths of the debt to GDP ratio, from the WEA, which is the green, that has that is a baseline with no spread. The other two, the red and the brown, are the one I just explained, where the dotted ones are, have higher interest rate and a spread, and the continuous lines only have higher interest and no spread. But the interesting thing here is the blue. So in the blue, what we did, what should the primary balance be to avoid this increase in the debt? And the question is it reasonable, or is something that is politically difficult? Of course, in this picture, you see that it is the primary deficit, sorry, the primary surplus increases. But then if you look here, which is more clear, the primary surplus, what we call here the fiscal effort, is not huge, but it goes from essentially 0 to 3.5% of GDP. Now, is anybody's guess whether this is feasible or not, and in particular whether a contraction of this amount would affect growth, or would make the 3% growth incredible. But what I think is interesting is the is the comparison, is the difference between what would happen if the debt was transferred to a European agency compared to the case where you do it at home using the primary surplus. And then there's a paper that various discussions on how the agency should be set up and how it would work. But this, I don't think we have time to go into this now. So my basic point is that we've shown with Next Generation EU that you can have issues of Eurobonds, call it whatever you want, Eurobonds, under the surveillance of the Commission. Now, Next Generation EU is a special case because it's tight surveillance by the Commission. So it can be done. What this, I think, shows you is that shifting the debt from the ECB to the agency frees up monetary policy. Now, monetary policy is constrained. The red and brown path that I've shown you are clearly constraints on monetary policy. And if you want at this point to allow the ECB to run the monetary policy things best, it should be freed from the burden of the debt it has acquired. Now, this doesn't mean that the debt is shifted on the rest. Or the agency still collects money from member states and uses the money to pay the debt. The only difference is because the debt is issued by the agency, you don't have a spread that you have individually countries, states. So there is an element of mutualization of the debt in this sense. As Giancarlo was saying, or Jeremy, we are close to a proposal, I think, next Wednesday by the Commission on a review of the European fiscal rules. I don't know if there will be something in the direction of European debt agency, but I think it's important. It's not so important in my view, so much because of fiscal policy, but because of the objective of making the ECB more like a normal central bank. I think I stop here, Beatrice.
Okay, excellent. Thank you very much, Francesco. Okay, so the floor is open for questions and comments. I don't know if Ottmar Issing wants to respond to the question whether he is being interpreted, whether the Ottmar Issing question is is still an open one or has been solved.
Beatrice, may I?
Yes, you may.
So, first a short comment on Paul's slides. I was not surprised, but he demonstrated that the same problems the countries had in 1992-93, it's the same countries that had the problems later within monetary union. So this leads us to the question, when we talk about convergence, we talk about convergence of inflation rates, of growth rates, etc. But the basic idea of joining monetary union was that countries should adjust their economic policies in total. And this has obviously not happened so far. Will there be a chance this will happen in the future? I leave this question open, but I think it's alarming. But the observation by Paul is alarming for the future of monetary union. Now I come back to Jeremy's question. I think he has shown EMU is an unfinished house. We all agree on that. And he mentioned many fields in which progress is needed, from banking union, etc. But rightly, he also pointed to the fact that the core problem is fiscal. And here I'm deeply concerned. I think as a Democrat, any Democrat should be aware that sovereignty on public finance is the core of a democratic state. A German professor of public law, Di Fabio, has called it das Königsrecht des Parlaments, the king's right of the parliament. Democracy in the UK started with that, when this competence on taxes and public expenditure was taken away from the king and transferred to the parliament. So this to happen, we need obviously a treaty change. Helmut Kohl had a clear view. Political union should even be finalized ahead of monetary union, at least happening at the same time. But after the assignment of the Maastricht Treaty, nothing happened on the political field. And it was basically the resistance of France. And if Macron has given tremendous, impressive speeches on the Sorbonne and later on Europe, but in his last great speech, he said he wants a sovereign France in a sovereign Europe. And I think this doesn't get together. This is just avoiding an answer to the key problem. Can we continue in undermining national competence on public finances without a treaty change? I think there are limits to that. And if these limits are not observed, and if treaty change is not achieved, then we will have a sequence of problems. The problems, just to mention, because it's so easy to grasp, there will be cases for the German Constitutional Court, and one day the court will say, this must not happen. This must not happen, and this will lead to a deep crisis in Europe. By the way, this undermining is also fostering extreme parties on the left and especially on the right. So I think we must not shy away from giving answer to this question. This is for me the key problem. And so I fully agree with Jeremy, but this remains a problem. And I think there's a need for more concentration on this democratic issue. Thank you.
Okay, thank you very much. I cannot resist saying one word, which is that it would seem to me that this discussion is a little bit the one that we've had for the last 10 years, but we are right now facing a war and an energy crisis, and Germany is in a bit of a different position than it used to be in the last 10 years. So I wonder whether the discussions of the last 10 years might actually shift somewhat in the next 10 years, because that is a little what we are looking at here, what we are discussing. The pandemic has already changed a lot of the outlook. We saw borders closing across Europe. That's less than 2 years ago. And that was ultimately overcome. So I'm not a participant in the discussion here. I am a moderator.
Beatrice, allow me one sentence. I hate to be identified in these discussions as a German. For me, this is not a German aspect. This should be an aspect of all Democrats in all European nations.
Right.
This is
but the point is that there is also a European Parliament and a democracy. But I have been gratefully adopted as a German. I usually identify as a German. So the floor is still open. We have 13 more minutes. Please, anybody who wants to intervene. Lucrezia, you're next.
Yes, for once, I really would like to sympathize with what Ottmar has said, because, we have been discussing about, European debt agencies, about, kind of technocratic solutions of the problems we have been facing. And I think in terms of the analysis, there is quite a lot of convergence. But at the core of the issue, if we recognize that the core of the issue is fiscal, which I totally agree with, and then actually, if you look at the history going to the euro and to Maastricht, that debate between the French and the Germans, was a core aspect of that discussion. Then was solved with a compromise. But we know that this is a compromise, and see that problem of the lack of the fiscal union and therefore of political union is still with us. So I wonder whether actually we should not try to talk to our friends, the political scientists, rather than only with the lawyers, and trying to think about what kind of democracy we can think of in a union which has that limit. Because after all, I mean, we are, complaining about Europe, but what about the world? A lot of the things that we need to do to solve the big problems have to be done at the world level. But, democracy is at the national level. So can we think of, ways in which we can construct a European demos which goes beyond parliamentary democracy and is actually, helps, construct that democratic capacity, through building of new institutions and so on. I think there is an active debate among political scientists and lawyers, and I think economists maybe should learn from that, okay? So get away from this trap in which we're still discussing about the same thing that we were discussing in the 80s.
Okay, thank you, Lucrezia. Is there anybody else who wants to intervene? Do the panelists want to have a word of reaction?
Maybe my reaction is, so I'm pessimistic for two reasons. First, I really thought this crisis, the latest one, was different. And in the last 3 weeks, we are back to, Germany versus Italy, it's all fiscal, you know, the 200 billion, do we need mutualization? It's just been unbelievably depressing. Second, I do think—
Welcome home.
Yes, I do think that the war does change a lot. I mean, it certainly humbles Germany in its own insistence on fiscal rules and the debt brake and stuff like that. And, you know, creative accounting is now no longer sort of an extra German invention. And I basically completely agree with what they did in substance. However, the problem is that in order to solve, I think, the problems that have been standing in the way of financial integration, which is sort of the key objective and counterpart of monetary union, you do not just need, you know, earmarked big pots of money for specific purposes. You need a real alignment of fiscal systems. I mean, you can still have federalism, right? You can still have state levels that have their own taxes, but you need a much greater degree of alignment to level the playing field and create you know, incentives. And you need to solve the damn doom loop problem. And here, you know, we have tried so many times, and it was impossible, even with the most enlightened Italian government that we will probably ever get in history. So in that sense, it is kind of difficult to see that we will get there all the way. But by the way, this is not just then a limitation on what the euro can do. This is going to be a limitation on the single market. This is going to be a fundamental EU limitation. I think you know, our inability to move forward on fiscal is really the single most important obstacle for everything. And I completely agree with Lucrezia. Then, you know, that should be the focus on how we go around that. But I mean, it really is so deeply linked to sovereignty in addition to democracy that I'm not sure whether we ever will in Europe.
Okay, Francesco, Martin.
Sorry, Francesco.
Sorry, Martin, go ahead. Go ahead.
Well, it's look, maybe this is because it's been so long since I was an academic that my sensibilities have changed, but I just feel there's too much ideal theory going on, as the philosophers would call it. And the pessimism and what is wrong is that the world isn't the way it should ideally be in the model. It sometimes feels as if what we're hoping is that there should never be a bank run and never a failed bank. But that's not the world, right? It should be that when they happen, we have got used to actually wanting to solve it. You know, we have some new institutions in place, to Jeromin's point about the doom loop. The doom loop is still there. He says, well, I don't know, if we have a couple of bank runs, you know, let's see how the new institutions solve them. Are they willing to actually write down creditors and so on? I mean, you know my views on this. I think a lot of this has to do with the political willingness of people in charge to use the institutions and powers that are there, rather than the old impulse of saying, oh, we need some other institution because the people in charge of the institutions we have didn't do the right thing. So I think there's a danger of going down that route. Another example is we're all deeply committed Democrats, and Otmar's points were very eloquent, and I share them, and I think everyone shares them. But at the same time, we tend to complain about politics as actually practiced, right? But democratic politics is German representatives and Italian representatives expressing different interests on behalf of their constituents. That's what democratic politics is. It's messy, it's ugly, it's divided. The question is, does it actually in the end produce decisions that are at least adequate and hopefully somewhat good? If we look at what the European Union has produced since March 2020, I think it's amazing. It's been, you know, both in the pandemic and in the war, the degree of unity and the sort of decisions that have been made from that unity have been far beyond what certainly I would have expected, and I would guess most of the people here had expected. So, you know, maybe things aren't quite so bad.
Thank you, Martin. We should always have you as the last word, I think. So, Francesco, don't bring us down again.
I'm sorry, I have to do it. It is, Martin, it's beyond fiscal and maybe more simple. I've spent the last 2 weeks discussing energy prices and gas prices, and there's of course the current prices. There's a huge rent that is being paid to producers and particularly to Russia, and there would be ways to cut the rent that is paid to Russia without reducing supply big time. And it is very difficult. It has been impossible. Today, the European summit will end with nothing, and we will keep transferring this huge rent to Russia for I don't know how long. And what I haven't seen in the last few weeks is these countries sitting around the table and saying, let's try to find a solution, which in my view would exist. And the concern of what would any solution do to my voters is a prevalent one. And I think the outcome or the lack of outcome on gas prices would be because in a sense, it's much easier than the big issue of fiscal policy that, like Otmar is saying, has to do with independence and democracy. We're talking about a very technical issue that could be addressed and won't be addressed. Sorry if I leave you with it.
Okay. Yes, no. I mean, as you know, I am totally in agreement that Europe, by competing amongst one another, countries and buyers, we are really at the core of then transferring a huge amount, not only to Russia, but to all energy producers. The question will be in terms of our, session here. It's the next decade, so we weren't able to solve it in the first few months, and the first instincts were not really cooperative on this one. The question will be: will there be a solution within the next year? That is the way, or the next 2 years. Is Europe going to learn that the externalities and spillovers from competing with each other in the energy, in the field of energy is costly, and that more cooperation might also be the better solution here? Question mark. I am on the optimistic side, but maybe that's just my constitution. I am also having to hand over now to Giancarlo for his closing remarks. This has been an absolutely fascinating 5 sessions from my side. Just a big thank you to all the participants, speakers, and all the people who have attended. We have covered, not only monetary history, but European history. And obviously, it's not over. There is more to come. I am firmly hoping that my positive view of Europe for the next decade is the one that prevails. Giancarlo, it's over to you.
Thank you. I really don't want to keep everybody unduly at the Zoom. Just 3 messages. First, Mary Opsall yesterday mentioned inside baseball. I didn't know what it was, so I checked on the web. And it's esoteric, highly technical information. There is probably too much inside baseball to appeal to mainstream audiences. Maybe the ERM crisis was inside baseball, but I thought, again, as quoting Beatrice at the beginning, it was really a turning point for Europe. And there is a lot of things that I think could be learned from looking at it from the point of view of today. Second message, I still think that the question of what Marison is an important question. I have a different take from it, which is, if you really believe that full fiscal integration is the standard for EEA, we are doomed. Clearly not. I thought it was a constructive question, which is, at one point, the political process of Europe and politics here actually feature very strongly. We'll find solution. In the past few years, I was convinced that there could be strong cooperation and integration over crisis. Now we have been setting forward ideas of funds, Euro bonds that would be addressing crisis. In moment of crisis, that would be the moment to create contingent institutions that would do it. I'm changing my mind. I think it's true that crisis drive Europe. Now we have energy, we have a war. There is climate change, by the way. There is climate change also coming, energy transition. And the cost of having forgotten about a common gas market, for example, with the ring around Europe is now very apparent. So I'm still, I don't want to be pessimistic, optimistic. I'm just saying that we need to go ahead, and there will be constructively some result that may come to our way. It is a political process, and as long as there is a minimum of trust across Europe. Remember, the 92-93 was a failure of trust, trust went down during the crisis with Schlesinger, for example, standing up and saying, I'm going out of the meeting on Bath, because they didn't want to complete lack of trust in 2012. As long as we can keep a minimum of trust and discussion going, sometimes from confusion, mess, and moment of pessimism, some solution come forward. So it is not optimistic note, it's just what it was in the past, hopefully will be the same before. I hope to have more of this initiative, but Beatrice, maybe we can find more way to go to history to learn about the present. So thank you very much for your patience. It's been a long afternoon today and yesterday. I learned a lot. I hope that everybody has done, can say the same. Thank you very much.
Thank you.
Thank you so much. Super. Great effort.
Thanks, everyone. Nice to see you, Ermin.
Hey, Martin, it's been great to see you, Martin.
Nice to see you. Thanks, Giancarlo.
I also
Thanks,
have to run. Bye-bye.
Bye-bye, everybody. Ciao, Paolo.
Ci sentiamo dopo?
Ti sento, adesso vado a teatro, ci sentiamo dopo.